Hello, everyone. Greetings. This is, for those of you who are new, I never know who's new and who listens to this more often. My name is Kristina Kuprina, from lead portfolio manager and strategist at Sequoia Wealth Advisors, doing my monthly update on the economy and also a little bit of talk about, common mistakes that people make in investing in financial planning and maybe ways to consider avoiding them or correcting them. With the caveat to that is everybody's path is different. Everybody will have different needs, and definitely you want to consult with either us, our team at Sequoia, our team at Sequoia, or with your financial professionals before making decisions, as each individual situation can vary. With this being said, again, for anyone who's new, please send in questions. I build this for you each and every time, and I personally find the economy exciting, fascinating, and I can be quite a geek about it, but not everybody feels the same way. Sometimes there's just one important topic you just want to get a take on. Shoot over the question, please. I got a few that's already come in, and I will be sure to get to everybody's question today. And then before I get started, one more thing is on our next webinar, we're going to have a special guest that's going to talk to us in detail about Social Security and Medicare and other important things to understand about these programs. What's really common is a lot of people don't know how those two programs really impact one another, how your current insurance, if you're still working when you're claiming, can impact it, how your taxes can impact it. Medicare and Social Security in its own can be a complex financial plan, and that impacts everybody of a certain age. So it's a really good idea to understand how this works at a high level. Katie Lemfeld and I are certified financial planner. Know this is what we use as part of the financial planning we're doing with clients. However, there's a lot of people out there that don't have financial planners, and this still applies to them. So please tune in, watch out, keep an eye out, because the speakers are really hard to get. So we're going to do it at a slightly different day of the week, I believe, than we usually do it. But we're definitely going to get that in because it really can have a lifetime of impact, in some cases hundreds of thousands of dollars in impact, by choosing or not choosing it correctly. Other thing is you can pass it on to your friends and family members who may be getting into their late 50s, early 60s, or into 70s even. So I want to bring that up. Really important one. It's really going to talk about a lot about those programs and how they work, and also getting into some of the other supplemental insurances with Medicare as well. And just again, really important thing, really ties into the financial planning. So with that being said, I will start with the economy, high level. There's not a tremendous amount of new information. For those of you who follow this very closely since last time I spoke, there are some things getting a little bit clearer that were a little less clearer 2 months ago when I did it before the ARC presentation. And then I'll get into those kind of common mistakes and how to avoid them, both in investing and in planning. The reason I'm doing this is none of this is designed to replace us. We are your advisors. We are your guides. We will always do our very best to keep you out of these mistakes, or common mistakes. However, again, not everybody has someone that they work with. And some people do their own investing, some people do their own planning, some people have never spoken to anyone, or unfortunately, sometimes they have really poor advisors or advice. So I think it's important just to get this information out there to the general public, just some more ideas, some foods for thought. But again, I must stress, it does not replace working with somebody who knows your individual situation. There are high quality financial planners out there that work on a fee only basis. So even if you are someone who does their own investing or doesn't have money to invest to begin with, you can work with a financial planner and just pay a fee for service. So that helps getting a second set of eyes on your decision making. Okay, so with the economy, boy, I don't even know where to start. Let's start with where we're headed. So as you've heard me say throughout the year, because the big question has been, where's the recession? When's the recession coming? Are we having a recession? Is it going to be all just great news from here on out? We are still, there is still not certainty in whether we get a recession or not, but I cannot stress enough, it doesn't really matter. It's more of a technicality. We had a technical recession early last year with 2 negative quarters of growth, but it wasn't officially a recession because the consumer was still spending and unemployment was low. But a lot of people didn't feel particularly good about last year. Markets were down. Things were really uncertain. We have rapidly rising inflation. The Fed was raising rates at a historically unprecedented level. So there was just a lot going on. And that's just economically when we get into the geopolitics. So even though we weren't officially in a recession last year, was a lot going on. So whether we go to recession or not is really not as important as a lot of the news media or other economists may have you believe. What is important is what else is going to be going on, and this is starting to become clearer. So the markets had a great run. I should step back a moment and remember, and as a reminder, the markets are not the economy. They're two different animals. The market can be doing one thing, the economy can be doing something else, and vice versa. So I will make sure I'm defining economy to the markets. So the market, stock market, had a great run up this year. Right? Everything said, okay, after last year, that's really great. But the concern is only a very small number of companies in that index that were actually doing really well. And the majority were not growing nearly as quickly. A lot of that had to do with on the preliminary hype around AI, and some of it actually had to do with real earnings and real numbers. So it was a mixed bag of why. September, traditionally, in a year, is a time when the markets become much more volatile, especially if they've had a run up early in the year. So the behavior this September, this big back and forth swings, is very normal and ordinary, but we're still heading to a slower time. So the growth into the end of this year and into next year is going to be much slower than it has been. Though again, I'm not going to call one direction or the other. Here's an interesting fun fact. You're going to be ahead of all your friends. So even though the majority of the country, based on polling, feels that the economy is doing poorly and or getting worse, this quarter's GDP numbers, so this quarter ends next week on the 30th of this month, this quarter's GDP numbers are going to be amazing, fantastic, very high numbers, higher than they've been over this last year. And of course the media will be yay, and well, certainly in politics, one side will be going yay and the other side will be going boo. It doesn't matter. It is an anomaly. It is the end of this cycle. This is that big burst I told you about that was going to come at some point. Well, the big burst is this quarter. So originally it was looking like the big burst might be earlier in the year. It got pushed out a bit, which is pushing everything else a bit. But it doesn't look like that is going to be the case after this quarter. So don't get caught entrapped, I should say, in, oh, everything's going great, because that GDP number is going to come out about a month after the end of the quarter. By the time that GDP number is released, I'll tell you if it's doing what looks like it's going to be doing, which is slowing, because we're already going to be out past the first month of a quarter. What does this mean to everybody here? I'll talk about that in a minute. But planning for a slower environment means holding slightly different investments than we held in the past, and also planning for what is the highest level of probability next year, which is stagflation. So stagflation, for those of you that either are my age or younger, or didn't remember the 70s, but that being said, stagflation is an environment with higher than normal inflation and very slow economic growth. Okay, so a lot of times what happens is inflation is a result of very high economic growth. One of the major causes, not all of the causes, one of the major causes of the inflation that we experienced over this previous year was the massive amount of money that was poured into the system during the pandemic. Too much money, chasing too few goods. It's a common textbook cause of inflation. There were a couple other factors in there, but that was the primary one by far. The Fed, kind of started a little bit late on the process of beating down inflation, so they had to get really, really harsh and have raised rates at a historically unprecedented rate, speed and height of how quickly they've raised rates. And I'll talk a little bit about that, because what's going to happen the next couple months is going to be likely towards the end of it, but it's going to have a pretty big impact. So that being said, that's normal. Okay, we got too much money in the system. The economy's overheated. The markets are overheated. Everything's overheated. The Fed's trying to slow it down. When they slow it down that quickly, they break things. You saw that with some of the banks that weren't as well run, basically failed. You see that with the banks tightening lending standards. You're seeing that in certain pressure on certain areas of the markets. This is normal. I'll talk about real estate a little bit later and kind of get into that, but anyone who's looked at mortgage rates recently or has a HELOC and is seeing them at 7% understands the impacts of this, right? And that's just, the tip of the iceberg with how much money is being lent out there and how much money is variable money. So that works well. So basically the Fed has, cooled off inflation. Inflation is dropping. The problem is getting that balance just right between going so much, so far that they crash the economy. Okay, and we drives us into recession. This is what historically usually happens. So you understand that there's a lot of skepticism with whether the Fed can get this right or not. At this point, there's a chance they may get it right, but it's going to be stagflation because inflation is stubborn and it's harder to get rid of. Because in the past, when the Fed would do this, rising rates to cool down prices, right? Cool down the economy, sorry. We were more of a goods-based economy. So it's the interest rate rises work better in a goods-based economy. It has much more impact on the economy. We are much more a service-based economy now, in which case that does not have as much of an impact on service-based businesses. So it's not cooling the economy as much as the as the Fed would like to see. Sorry, not the economy. I misspoke. Cooling inflation as much as the Fed would like to see. So they're going to stay on it because they want to see us get back to 2%. Most of us economists believe that that will not happen without taking the economy into a full recession. So there is a chance that the Fed at some point may say, well, okay, we'll take 3% and we'll call it a day. So they may back off of that 2% number. It's really low. It's a nice number, but it may be lower than is realistic given demographics and given geopolitical events and given other factors as well. So there's a chance on that. Why I'm bringing this all up is stagflation. Higher inflation than normal, slow growing economy is the highest probability for next year. And whether or not that becomes a recession, which is another step, is still, again, a question mark. What does this mean to you, to everyone here, is planning for that. So it's always good to plan for it, right? It's good to have a plan A and a plan B and be adjustable in what that plan is. So the first one that you want to figure out, of course, is just, does it really matter to you in your plan? That's a whole nother conversation, but that's important to know because sometimes there can be a reactionary feeling to news, but there's not always something that you need to do about it. And the second thing is that if you have not taken a very careful look at where your money is and all the little buckets you have it in, it's a good time to review it at a minimum to make sure you're getting properly paid on your cash that you're held in banks. So there are some things that you want to make sure to consider to do, especially for those of you that don't regularly look at your finances, regularly look at your savings. But I've talked to quite a number of people that have a pretty large sum of money in the bank and they're not earning anything close to the going rates on our money market accounts that we're using right now. So just with the cash alone, make sure it's working for you. There's even some strategy within that, how you play that as well. So just make sure that, again, things are positioned well. Another big one, so I'm just about to talk about next year, stagflation. Some companies will get through it really well. They have really steady sources of income that are pretty bulletproof even in that environment, right? But companies that are very focused on growth in some areas will continue to do well. So it's not as if growth won't do well, but companies will be more careful where they spend their money. Consumers, the average person, will be more careful where they spend their money as less money becomes available and it costs a lot more to borrow it. So, what you see is a lot of pruning and trimming around the edges. So a lot of things have done well. It's time to review those things and see if they still make sense just over this next year. Into 2025, the economy never follows perfect calendar years. So we'll say into 2025, things are still looking really good. So this is kind of a year of stagnation and to be able to figure out, again, how to position for it. Government shutdown. I'm sure I'm going to have a bunch of questions about that, so I might as well talk about it. Yes, yet again, we are back in this space with our illustrious politicians and the government or the potential for running out of funding and government shutdown. I'm going to take a slight risk here in saying this because this is how it's always played out in the past. There's always a risk that something will change in the future. But I'm actually going to say it's less likely right now because we're coming up on an election. And no party wants to be the one that actually completely blew up the system. So while we could go over past the date, and when the government could have to patch things together and do this extraordinary game playing, shell moving things that they do every other time that this happens, and they go past the deadline, they may or may not get it resolved in time, but they probably can play it out for a little while afterwards. But it's going to be a lot of noise in the media. It's going to be a lot of political noise. Oh my gosh, these people will lose funding. We're all going to die. That type of thing. This has happened a number of times. Sometimes it's gone on for quite a long period of time and there has been things that have to be moved around. Other times they've resolved it in the last minute. I'm going to expect that this is going to be the same thing here again, but it's going to be a whole lot of noise to get us there. Noise will be increased because, again, we're coming on election next year. I called election year now because it feels like it already started. But there's going to be a lot around that, but it's truly not an imminent economic risk, but there always is a risk at some point that there will be politicians in place that would be willing to drive us completely over the edge. And what it would just do is it would just create cuts in absence of money. Money can be moved around and adjusted, just the spending cap gets locked in. Deficits do matter. Is becoming increasingly difficult to manage the amount of debt that we have. It's quite stunning how much we have and how quickly it continues to grow, even absent of a pandemic. That being said, there's going to be a reckoning point where we just simply cannot do this anymore, probably within this decade. I'll keep you posted on that. It's not today's problem, but it's getting closer than it has been in the past. And it's important to keep a very close watch on that, especially because it will have an impact upon investments. It will also have an impact upon your ability to borrow, especially, again, things like mortgages. It does have an impact on the average person, so we will want to watch that very closely. But at this point, a whole lot of noise from a whole lot of politicians, and each party will play it to their political advantage, and it will be heightened or hypered up a bit more given it's an election time. I think I talked a little bit about most of these things. Now let's say something a bit optimistic. Can we say something optimistic and positive? Here's a secret happening in Washington right now. There are actually a group of Democrats and Republicans, well respected. Some of them will not give their names, some will, but we know who a lot of them are, that are working on a fix for Social Security. And here's where it's exciting. It's actually doable. It's doable because it involves quite a few tweaks and changes that each side would give up a little of something to get us where we need to be to fund it at a very high degree, and the differences can be made up. And the great news is this is bipartisan. It's coming together, and it's the stakeholders seem to be in agreement that this is the right direction. This is very important because whoever gets into the White House next year and whoever's in Congress next year actually have to vote on this, and it involves Social Security. So as you can imagine, it's a very sensitive subject, but the program has to have these reforms done or it will simply not be able to continue working within the next couple of years. I want to bring that up because that is positive. It's like really stuff's getting done in Washington. Some really great people that are working on things. I would imagine we will hear nothing about this until after the election because of the political risk. But it is happening, and I've seen the kind of the blueprint for it, and it's pretty cool. So anyway, pretty positive news into the world of Washington, from the world of Washington. I talked a little bit about September. So September, October, traditionally more volatile months in the markets. However, this time, like I said, we had a really big run early in the year, so letting some air out of the tire makes a lot of sense. As a reminder to each and every one of you who invests, if any of the bumpiness is uncomfortable, be sure to talk to me or talk to your financial professionals, because you want to make sure that you know the ride before you get on the bus. We've had some really extraordinarily unusual times when things that have essentially never happened before or haven't happened before for 100 years have happened, where there's been odd mixes between how stocks behave, bonds behave, things like that. So it's constant diligence in watching portfolios. But when you have the Fed doing what the Fed's been doing, it's hard to fully explain the massive disruption that's taking place within the financial system. When you go from near 0% to 5, where we're now to Fed funds around 5, that's huge. The impacts, the echoing throughout the economy, and right now you don't necessarily see all of it on your average day to day, but we see it. We see how this is going to start to spread like ripples through the economy, and it's going to continue to have impacts. This is historical what the Fed's doing. Also, the Fed has changed their mind, which is really throwing the markets off too. So what the Fed told us early in the year they were going to do in relation to rates would set a bond portfolio, but guess what happens? They changed their mind. It changes everything. So with stocks, there's certain data, a series of data that you can look at and make decisions. With bonds, it's the Fed. When the Fed changes their mind, it changes the market. So it makes things a little more tricky for decision making. So again, when volatility is a concern, be sure to reach out to your professionals, make sure you're aligned properly. There is always a price to pay for growth, and you just want to make sure that you're getting the right growth for the fluctuations that you have. Another one I want to bring up is economy. It's just, kind of a thing that sounds really great, and then there's also some considerations with it. Are the new obesity drugs that are coming online. Okay, what the heck does that have to do with the economy? A whole lot. So I think it's Novo Nordisk and Eli Lilly have obesity drugs that are coming online. and they have a great success rate. And of course, we're talking about obesity. We're talking about people that are morbidly overweight or significantly overweight, and it's creating health issues. In addition, they're running studies on these drugs, and it is possible that they can also help with sleep apnea and or diabetes number 2. This is huge. This is huge because of the cost to society, collectively overall with the health in relation to those two. I mean, sleep apnea, notwithstanding the health issues that it can create, also too is a productivity issue, right? I'm sure if you didn't sleep well at night, you're probably not going to be as productive the next day, or maybe even as safe driving around. With diabetes 2, of course, that's a rapidly increasing thing that oftentimes can be corrected through diet and lifestyle changes, but not always. And so having another option out there that can help with these conditions is probably a good thing. I guess I should put the disclaimer here that I am speaking as an economist. Do not take any health or medical advice from me, or even think about it. Talk to your doctor, healthcare provider, before making any decisions about any medications or what they can and cannot treat. But that being said, it's a big deal as these come online, but not maybe in the big deal in the way you think. So it's great if we can find solutions for these conditions, and there's even more exciting things coming along the pipelines right now. However, the cost of these drugs is very significant because they're new and early. So traditionally, things like Medicaid / Medi-Cal and Medicare will only pay for drugs for a specific medical treatment. So obesity has traditionally been seen as a lifestyle choice, not as a medical condition, though that has changed with some coverage, especially in Medicare, not Medicaid though. But that being said, if they can also treat these other medical conditions or help with these other medical conditions, then they have to be covered. So the costs are pretty significant. If just 10% of the Medicare patients who are obese, defined as obese by BMI, body mass, BMI, 10% take it, it's going to be $26 billion, or 20% of Medicare's spending on drugs. So that's, again, just 10% of the Medicare patients who are obese take these drugs. It's going to be 20% of Medicare spending. That's big. So something's going to give somewhere, somehow, in the cost of healthcare, because obviously this is going to be the same thing on the Medicaid programs, which are, again, taxpayer / worker funded, but that also will spread on to private insurance as well as company insurance plans as well. The cost has to be absorbed somewhere. The hopes are that over time, it's going to be about 2 to 4 year lag roughly from when this gets widespread use to when you start to see the financial impacts of improved health outcomes. So again, I'm talking as an economist here. I understand completely that money is not nearly the most important thing when it comes to the health of individuals, ourselves, and our country. But I want to bring this up because you may start to see some costing pressures or some reduction in benefits on certain insurance plans to absorb the costs of these new drugs during the time and before that healthcare benefit on the back end hits. And I bring this up again to speak economically, but also to show what is happening now in the healthcare space. The healthcare space has a lot going on right now, both with the gene therapy that we talked about at ARC last time. A lot of this stuff is speeding up rapidly, and we will probably see in the next 3-5 years, probably up in that range, massive changes in the healthcare system and how we treat things. That's happening. But I wanted to bring up the obesity drug from the standpoint of it's sort of a game changer, but it's going to have a pretty big economic cost for now. Just sort of a little extra thing. All right, I'm going to hand over to the other questions. Let's see. It says, how have bonds, etc., in a low risk portfolio been doing? It depends on what it is that you want those bonds to do. So, and also how you define risk. So risk is a word that has a lot of different meanings. So a risk, for an example, could be I invest in this thing, I lose all my money, right? Goes to zero. Another risk, which is more common when people talk about traditional types of investing, is the risk of volatility. So if my portfolio is worth X, it can go up and down and up and down and up and down. But if I need to sell on a down, I can lose some money. Then you've lost money. But you didn't lose money or make money on the ups and downs, really, because you didn't sell it. people can see that as, well, obviously people never see the upside as risk, but the downside, right? It's worth less than I invested. Another kind of risk is also interest rate risk, which can have an impact as well. So for an example, if you invested in a bond and you're getting the income from that bond and life is good, you're getting the income, you're living off that income, great. And the bond you're holding to maturity, so it doesn't really matter. You'll get, again, assuming no default, you get your money back at maturity, you're getting that. But what if that bond has been paying you 3% and you've had it for 5 years and you're happy as a clam at high tide because you're like, I'm getting 3% on my bond and my bank's giving me 0.0%. I'm so happy this bond doesn't mature until 2030. I can keep getting my 3%. So you felt really good about that 2 years ago. Now, maybe not so much, because now you could put that money into something else and have a higher interest, income paid out to you, right? Because rates are going up. So sorry, that was maybe a little bit long of an answer to that question. So how your bonds are doing depends whether you want them to preserve principal and value, or if you want to get a higher level of income, or some combination of that as well. The other thing is, what are you comparing it against? That's what you want to look at too. What are you comparing it against? Are you comparing it against cash? Are you comparing it against stocks? Are you comparing it against different kinds of bonds? So the comparison is always a good idea to do specifically with your advisor to make sure, because sometimes also your life needs change. So perhaps you put the money in bonds because you wanted it to be stable, but now you're like, oh, it'd be really great to get a little extra income every month because inflation is eating my budget every month. So say, hey, instead of reinvesting all that income, send me some. Great, it takes off some of the pressure that you may be having on your household finances due to inflation, and you're still reinvesting the difference and you're not touching the principal, which is nice because then you can keep getting more and more income. That's really important. So hopefully that answers that question. And I can get more specific with you when I talk with you directly to answer that question. But in general, for everyone else, it's one thing. If you have amount of money set aside and saved, it's a really good idea to periodically take a look at it and be really sure it's doing what you want it to do. But I'm also going to get into the other parts I talked about today, which is the common mistakes and how to avoid them. I'm not someone that likes to speak in negative words and negative terminology, so I kind of hesitated with that title, mistakes and avoidance, and it sounds so. I'm going to frame a lot of this in kind of more optimistic terms, but the reason mistakes are uncommon, I want to bring that word up, is because a lot of people don't know they're doing them. They're kind of innocuous, and you don't know, but it can have a really big impact. I'm going to talk a bit about the investing side, and I'll talk a bit about the planning side, but this is by no means all encompassing. There are many, many, many more. And commonly when I review someone's portfolio or their plan for the first time, the mistakes are just completely unknown to the individual, right? It's like, oh, I didn't know that, or I didn't see that, or understand that. And our reason is, I believe please don't take this in any way as any form of judgment or blame. We are really, really not well cared for in this country on the financial side of things. There's literally no financial education or literacy in times of our life to actually understand how a lot of this works. Finances are becoming increasingly complicated. Taxes, insurance, everything is becoming so much more complicated. Even since I started 37 years ago, it's just becoming increasingly complicated. This is my full-time job, and it takes a big chunk of my time keeping up with all the changes, all the laws, all the regulations, all the economic factors, all the tax law changes. It's a lot to do. It's really hard to do as an individual, doing it part-time in your plan, in your portfolio. So we don't have the education and literacy. It takes a whole lot of time and energy to stay on top of it. It's boring as heck for most people. I'm an outlier. I know. I think it's cool and interesting. But, I think sports is really boring. So people argue with me on that one all day long. I don't mind playing them, but I don't really like to watch them. We all have our passion, we all have our interests, but for the vast majority of our population, people would rather do anything else than stare at their portfolio or work on their financial plan. They'd rather get their teeth cleaned. It's just not fun. It's not made to be fun. You're either talking to somebody that just is going to sit there and tell you how smart they are, why you need them, and how bad of a job you did. Ugh. Nobody wants to do that. That's not even remotely fun. But we kind of know you need to do something, so people get sort of stuck, sort of patching it together. And the final one is, I'm going to throw it on our industry. Why Sequoia is very different in the way we do things is because commonly If you want financial advice or financial planning advice, it usually involves buying their product. Like they have a product to sell you. Oh, the solution to everything is our annuity. Oh no, annuities are bad. Don't think it's like just all this nonsense from people trying to sell a system or a product. And I have never ever seen a system or a product being a solution. It could be part of a solution. It's never the whole solution. But people are smart. They know when they're being sold to, and then they just get turned off from talking to any professionals. And again, are patching it together. So there are other reasons perhaps, but I always want to make sure I'm coming across very clearly as non-judgmental in any way when I bring these things up. But I'm seeing this. I've seen it for years. Some of this I see a lot more recently. And the earlier you can catch it, the more probability you'll have of being successful. So I figured to get this to a big audience and as well as clients on an individual level is really helpful. And the one thing I want to say before I get into this is think of investing and financial planning to a degree of this. You have 3 different stages, okay? I don't know why every time I say that I think of like the stages of a egg to a butterfly, right? So you have stages, right? You have the earlier stage, which is the accumulation stage, which is you're saving money. Maybe you're saving it in your retirement plan at work. Maybe you're saving it in the bank. You're going to buy a house. You're going to start a family. You're just saving it because your coworker said it was a good idea to put money in the 401k. Whatever your reason is, you're saving, you're accumulating. What you invest in really matters there, but in a different way. You just really want to accumulate, grow, accumulate, grow, accumulate, go. Your biggest, like I said, negative, quote unquote, is you're working with smaller amounts of money. It's going to take you a while to build it up because you're just saving here and there. But the plus is you got time on your side, and compounding, and the power of compounding is the greatest power that's out there. So you've got time on your side, you've got compounding on your side. For the most part, you're not worried about what the markets are doing day to day. You're just socking money away. That's accumulation phase. Then you come into preservation. You get to a point where you got to take at least some of this money and start thinking about how you're going to preserve it, because it's not too far in the future you're going to start to tap into it. Not all of the money, because of longevity, which we'll talk about in a moment. Some of that money, you're just going to start, this is where planning gets important. Start creating the buckets, make sure that you've got enough to meet all your needs, the right place, right time. And then the longer term distribution or longevity, okay? You don't run out of money. So any younger people that are listening, they're in accumulation phase, that longevity thing is like, oh, that's what old people do. I don't know. Well, I can't even imagine being that. Well, you'll get there someday, but it's kind of out of how your mind is. So some of the things I say are going to kind of be focused a little bit more on different groups in this, whether accumulation is going to be less important or distribution or longevity be more important. Just keep that in mind. Where you are in that life cycle is where this importance is going to be, but awareness of it is important. It's also not only awareness for yourself, it's also awareness for the other people in your family. So if you're on the older side of that life cycle, giving, investing advice to your kids, they're not going to invest like you will. They invest differently than you will, but your wise decision you made through your lifetime is great knowledge to pass on to them. Especially get it to them while they're in accumulation, because they got time on their side. As you get into, I'm 54, almost 55, so as you get into this mid-50s or even early 50s, really starting to think about, hey, I'm going to start to tap this money. How am I going to build my buckets out there so I continue to grow so I don't run out, because based on my family history, I'm going to live well into my 90s or beyond, how you don't run out, but also that you got stability in what you're drawing from. Because if you have to draw from money when it's doing this, it's usually not a good outcome. So you want to make sure you have those buckets done and really start to think about that. Now, I am using ages based on the traditional retirement age of 60 or 65. There is an increasing movement for people to retire much younger, which requires far more aggressive planning much earlier. We do a lot of this, kind of early retirement, retire at 50, retire at 55. It's becoming increasingly common. If you want to do that, get started really early. Unless you're inheriting a lot of money or have a lot of money, get started early. It's doable, but get started early. The longer you wait, the harder it gets, because your time horizon is compressed. So do that. So, alrighty. Now in investing, number one mistake that I see most often with people doing investing is not having a defined goal. What am I trying to accomplish with this strategy or this portfolio? Because that's your target. You have a target. What is my goal? It also helps prevent you going into being too conservative out of fear or too aggressive out of greed or whatever, that gambling mentality, right, to betting on stocks. Because how can you know if you're doing the right thing if you don't have a goal? Your goal will change over time. Your goal should be too flexible, not target, but have a goal, because there's something you need to be benchmarking yourself against, and it should not be the S&P 500 or the bond index. It's not that simplistic. Your needs, your life, your goals, your expectations, your vision, what you want is not the index. It is completely useless. The index is what people use when they just have no idea what they're doing. It just, or if it's a part of an investment policy statement for an organization or something, you've been hired. So sometimes it is a target, but with individuals, it's pretty meaningless. And I'll give you a quick example. There's a 10-year period where the S&P 500 did nothing. Well, you got 10 years older and didn't make any money. Is that a good thing? Bad thing? Well, historically, the S&P 500 does 6% or 8% or 10, whatever calculation, depending if you reinvest dividends or not. Well, yeah, that's 90 to 100-year data. People aren't investing that long. You lose 10 years, you've lost a big chunk of your accumulation time. So what the market did is not what you want to do. And boy, if you're on the distribution end of this and your portfolio took the drop like it did in 2008, you may not have an opportunity to recover that, in which case you run out of money. So you can say, wow, I only lost 30%. I beat the S&P. Oh, it's fine. You're going to run out of money. It doesn't matter. So do not use an index. Use a goal. Goal usually comes from planning, and stick with a goal and adjust the goal when your life changes. When would your life change? Costs go up. Plans change. You want to work longer. You want to work less time. You start to support your kids. Start to support your parents. A lot of things can change those numbers, so it should track within your plan. So define goal number one. If you're doing this on your own, if you're working with a professional, define a goal, and everybody knows the target. And that goal should be net of fees and taxes. Critical. What you actually put in the pocket at the end of the day is what the goal should be. Which brings me to number 2 on this list, which conversation was not understanding taxes. So we tend to be oftentimes compartmentalized in our financial lives, right? We say, oh, my portfolio did X, my investments did X, that's great. And the 1099 comes, next year. And you don't really make that connection between what did that cost me in taxes. I said there's so much that goes into the secret sauce of my care for my clients that nobody ever sees, you don't know about, because I'm quietly doing behind the scenes. But a big one I do is tax harvesting, tax loss harvest, tax work. It is I always say it's the gift you don't even know you got, is when your 1099 looks a lot better than it would have otherwise looked, which means potentially giving a lot less money to the government. There's a lot of strategies that play in the portfolio, usually in November and December. Working on each portfolio taxable account, trying to optimize that, because the less money you pay in taxes, the more money you get to keep, and that's guaranteed. And I don't get to use that word a lot in my line of work. So understand taxes, understand the impacts of putting money in a certain account, understand the impacts of taking money out of a certain account, understand the tax impacts of different types of investments, and understand the tax impacts of selling stock at different times. Short-term games are a whole different animal than long-term games. Understand how that works. You can have great portfolio performance and give a big chunk of it back to the state and to, if you're especially in California, and also the federal government, in which case you really didn't make money, even if it looks that way in your statement. The other one is putting a lot of money into 401ks, traditional 401ks, IRAs and whatnot. You are deferring your taxes. You are not eliminating your taxes. So careful financial planning is critical here, because it can prevent a situation where you defer your taxes, you pay less taxes throughout your high earning years, Then you get into retirement and you start drawing off that account, whether you want to at 59 and a half or older, or you have to at 73. And then you're paying all that money out in taxes then at ordinary income levels. So remember, deferring, not eliminating. Traditionally, people say, oh yeah, I'm going to put it all in the IRA now, or all in the 401k now, because I'm at my high earning years, and when I retire, I'll be earning less and my taxes will be lower. That depends. In the old days, that was true, because when people retired, they didn't have much fixed expenses, right? And so they went from earning X and living off Y, like living primarily off Social Security with extra money. That's not the case anymore. People go into retirement, they're not spending any less money. A lot of people have mortgages in retirement, a lot of people have expenses. So think very carefully about what in your expenses, monthly expenses, will change when you retire. Okay, some things might. If you're putting the kids through college right now, yeah, that's going away. Okay, if you're doing other things that are short term, that's going to go away, but your overall expenses aren't going to much change. So when you stop earning money from your work, you're going to have to pull from somewhere. There's a lot of strategies around this. Please know there are tons of solutions, more than I can mention, even if I talk the whole hour about them. But understand the taxes. Does it make more sense to put money in a Roth, a 401k, pay down your debt instead and not put money in there? There are times when I literally will tell clients, do not put any money in your 401k. Don't put it all here instead. You're going to be so much happier in retirement. Don't follow traditional wisdom because it's too generic and everybody's situation is different. It's really important on that one because taxes are guaranteed loss. They're gone. You don't get them back. Let's see. Another one is, and kind of ties in, is investing like others. There is not a one-size-fits-all strategy. There are investment firms out there. There are talking heads. There are, I'm sure, podcasts and webinars, all sorts of things, people telling you how to invest. How to invest. Could be family members going, oh, I did this thing and I made all this money and it's the right way to do it. Or conversely, it could be, oh my God, the world is ending. Don't invest in this because, well, you lose all your money. Kind of fear-based more so. The system's going to collapse, etc. There is no such thing as one size fits all. There is no such thing as one strategy works for everyone. Just like when you go to the grocery store, right? You know, some people need a certain type of food because of the costs. Other people need a certain type of food because of dietary considerations. People may have preferences. Maybe it's what's going to meet your home. It's all food, right? But there's different ways to consume it, different ways to buy it, and different ways to do it. Depends. Investing is no different. It is a lazy way of trying to tell everybody or groups of people they should all invest the same way because it's low cost, because it's traditional wisdom, because my grandpa did it that way and he's blah, 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 or because so-and-so celebrity investment person said so. Trust me, I get paid a fee for service. If there was a way that worked for everybody, I'd be on it like you wouldn't believe. There's not. It's very customized. It's very individualized. And what works for someone else may not be right for you. So that's a big one I see really commonly. Paying attention to the news. Okay, the news, the mainstream news, you know, the news that comes out there and whatever your preferred news source is really pretty much useless when it comes to investing, by and large. By the way, when the information is on the news, everybody knows it, which means it has pretty much at that point, whatever's going to happen has already happened. Number two, a lot of the things which pass for news are actually opinions. It's not necessarily facts on the ground. Or a fact happened, an event happened, a fact happened, but then there's people's opinions on it, right? It's not actually, here's the data. It's interesting to me because I get an actual news feed, which is a sentence long throughout the day when I'm trading, and it comes across as just one sentence of each thing that's going on in the world, as well as domestically. And it is probably the most clear idea of what's happening in the world at any given moment without any of the opinions, any of the hype, any of the nonsense. And then I see, if I check the news once a day, each day, the main news programs, because I know that's what my clients are looking at. Just a quick shot on the screen, on the internet, just because I don't want to spend more time there than necessary. And yeah, everything's hyped, everything's exciting, everything's the end of the world, or the greatest thing since sliced bread. Everything's just, it's like a soap opera. But do not make investment decisions based off something that you see in the news, because it's rarely very valuable to you and your specific plan. And even if you're just purely speculating and trading, I said, you don't know how it's going to play out. There can be news that makes it think it's very cut and dry, and that's not what this market thinks about it. So ignore the news, and certainly ignore the politics of it. I'll talk more about politics next year, as I'm trying to push that off as long as possible. Now we'll talk more about next year as we get into the real election year. But I will just continue to remind you that the market does not care who the president is. It doesn't matter. You may care, but the markets don't. See, the clear understanding of the risk to reward of any investment decision, as well as the cost to benefit. So sometimes cost to value. So sometimes people get really stuck in, as people say, I'm going to invest in this because it made all this money. It's done really, really well. But the thing is that you don't understand that risk that it took to get there, because the market was going in the right direction for it. So you should always know the ride before you get on the bus. You should clearly understand the risk, and you may accept it. Thing I like to do a lot of times with strategy is tell people that we have a potential for this much fluctuation. It's kind of standard. It can happen. and say that, and then people can make a decision if they can accept that, right? And just understand it in whatever way that needs to be communicated to you, that you understand it. I can talk at length about these things, but any of you want to know that, so talk to me. I'll explain it to you very clearly to make sure that you always know. It's not a guarantee. It's not a promise. There can always be extreme events. This year, the bond market was an extreme event. It's historical went up. Usually, it's odd. Last year, the bond market was more volatile, but it was more expected. This year was the Fed changing their mind. And you can't plan for that, right? The Fed changed their mind from what they told us. They changed their mind, and so everything changes. There are no guarantees. There's only probabilities. But just understand the risk to reward of any investment you make. Because when you look at the risk, and you can look at that and accept it, then if it happens, you're prepared for it, and you're just going to sleep a whole lot better at night, not worry about it. Low cost of value is another thing too. Sometimes people think that things that are expensive are more valuable, or things that are cheap are more valuable because of how they see cost of value. It is not the cost of something. It's the again, the value you get for it, right? So think about the vehicle you drive. That's why we usually say to people, we think about the vehicle you drive. Why did you select that vehicle? Okay, and there was features to it that made it worth paying that extra money that you paid for it. Different people will be different features. Some people will be safety. Some people will be a designer car, designer name. Some people will be environmental, green type of vehicle and whatnot. Just understand it. What am I paying? What am I getting? And I'll quickly pick on me for a moment here. All my performance reporting that I do is net of fees. Everybody knows what they're actually making. I don't hide a thing. It's all out there. It's all transparent. And then we can always talk about here's what we're doing and all of the services and whatnot. And when people start to understand it's not just the investments, it's all this other stuff, then you can start to see the value. But there are times when it doesn't make sense too, where people get trapped. On the other side of it is being in an old 401k plan that you kind of neglected and left out there floating from a previous employer, and you're paying all those ridiculous fees on all those funds, and nobody's managing it, nobody's adding value, and it's costing you a lot of money. So fees can be bad if there's not a value for that fee. So just understand your cost to benefit on all your investments, as well as the risk to reward. Sorry, I can go on with that one for a long time. There's a lot of examples of that. Small one, if you're doing your own trading, is a defined buy-sell process. So a lot of times what I see individual investors doing is they get all excited about something and they buy it because they think it's going to do really well, or conversely they sell it because they get scared or they're concerned about the prospects for the company or the market. But there's no defined process. It's just fear, greed. I want my portfolio to be at this level, so I'm going to buy these things and I'm not going to stop being aggressive until it gets to that magic number that I just made up. Conversely, which is, oh, my portfolio's down, I gotta sell, and there's because emotion now drives you. You have no defined process, you have no goals, you have nothing. You're sort of gambling or playing around more than really investing. Fine, it's your money, it's your choice, but just be aware of the difference between a defined process and kind of more emotionally reacting or sort of playing around. And the final one I wanted to bring is understand that there is more to the world than stocks and bonds and real estate and the things that people think about. There are very distinct strategies that we use in client portfolios. Again, this is not a recommendation for how you should invest, because everybody should invest differently. Talk to me individually and I'll give you more specifics. But there are risk mitigation strategies that can be done to portfolios to help mitigate risk. There are market neutral type of strategies that are not tied into the stock or bond markets that can potentially add a benefit. Liquidity pools where you tap, that's more stable, especially now that rates are higher. So it's not as simple as, I'll just buy this index fund, stick them together. And no, there's other little pieces you want to put in there, because the money needs to be there when you need it, and you want to make sure of that. So there's lots of other little things that can be added within a portfolio where appropriate. Options, income generating strategies, writing covered calls. There's lots of things. Again, none of this is recommendations. It's just ideas to think beyond the traditional, I'll buy a couple stocks. Again, you don't have to get fancy just to get fancy. You want the highest probability of achieving that goal. Okay? Because the highest part of all what you're doing is you have that pyramid. Remember that vision, your life's purpose, whatever the heck this money means, either now in your lifetime or beyond, if you want a legacy. And everything else stacks down below that. And investing is somewhere in the midpoint, a little bit lower than the midpoint actually of that decision point or action you have to take. And the very bottom of the pyramid is like the tasks you have to do to get there. So planning can be fun. All this can be fun when it's tied to your goals, what's important to you, and where your values are, which for the most part, for most people, it's not money. And most of the time, it is actually what it is they wish to accomplish in this lifetime or do for themselves, for others, for the world, right? That's what we're working for here. We're not working just to make giant piles of money to look at. Okay. I didn't get any questions on that, so either hopefully that was useful or I answered everybody's questions. Okay, so that one I said I want to jump into planning. Okay, so financial planning is actually a little bit trickier than investing, only because less people do a formal, proper financial planning than actually invest. So I want to just give some pointers and some ideas. This was going to come more so considerations in planning. Considerations in planning rather than mistakes to avoid. You really want to have goals, even if you haven't figured things out yet. So a lot of times what stops people from doing planning is, I don't know when I'm going to retire. I don't know when, there's just like, I don't know. It feels like life's uncertain. And life is super uncertain. It's super uncertain. I don't know if there's ever been a financial plan that we've done that we haven't modified and adjusted and even sometimes completely redone because life has changed for our clients. I don't think there's ever been one. Katie, you'll be able to correct me if I'm wrong there. That is a big deal. So, but start with what you know. So I'd like to see if it's possible that I stop working at 60. What would that look like to me financially if I did that? Just start with that. You don't have to know the answers to everything. A plan is a living document. It's updated. It's changed. You can start simple and add on. But when the basics are put in, it's easy to modify it and do it. But you want to have some kind of goal, something to shoot for, even though you're well aware that the target may change, the goals may change. They may change for what we call, positive reasons. You get a purpose in life or a passion, and you decide you want to pursue that, and you're going to change, and that's now going to be your target. Sometimes a change in health status can be a change in target. I'm going through that with some clients right now, and it's not an easy path on a lot of levels, heart as much as the financial aspect. So you plan for what you know, enhance it as you know more, but do something. Put a target, because without a target, you're just floating around in the sea with no plan, and you're getting older, and you're getting closer, and you're getting older, and you're getting closer. One day you wake up and it's like, uh-oh. You want to have the plan sooner rather than later. Holistic vision is another one. Don't just focus on the investments. There's a whole industry full of people in the finance world that want to sell you a thing. They want you to focus on, if you have the right investment, you'll be happy and successful, and you and your partner will be walking on the beach holding hands together, and it's all a bunch of crap. Okay, really, really, you want to think about things holistically. It is a series of decisions that you make over a long period of time. Those decisions will be adjusted based on the needs of your children as they grow. A lot of people's kids now are taking a lot longer to launch, and some aren't launching at all. That changes a plan. A lot of people, their parents are living a lot longer, and do get to the point they run out of money because they did all the right stuff financially. They didn't expect to live that long. Okay, my grandma's still alive. My grandpa, the reason he's not with us is he was shot in World War II. So there you go. Just an example, right? People are living a lot longer in retirement, and that's why you want to plan carefully. But right now, maybe you're taking care of your parents financially, and if you're not doing it yet, you may be in the future. And I'm one of those people that's going to be doing that in the future, high probability. So think of things holistically. Don't look at your taxes one way, in one bucket, and your investments another bucket, and your insurance another bucket, and your Social Security another bucket, and your savings, and your house, and your real estate investments. Don't look at everything separately. Look at things holistically. They all fit, they all intertwine, and if you can clean that up and connect everything really well and understand how this impacts this and this impacts this, the beauty of that is you will be far more likely to be successful, and there'll be no loose ends that you've missed. And sometimes you can actually find a whole lot of extra money when these things get pulled together. Remember the example I gave earlier about investing in taxes? Man, some of the biggest things, Kate, I can do in financial planning is save our client boatloads of money on taxes by moving stuff around. That's so exciting. It's like, we just saved you on taxes, way more than you're paying us. It's beautiful. It's just because it's cleanup, right? Cleanup and organizing, kind of like what you have to do when you're going to sell a house. Okay, I talked about this a bit earlier. Change happens, plan for it. Don't become too rigid in your planning that you can't accept the fact that life will change. You may change it. It may change itself on you. but life changes. So the opposite of not having a plan, of floating around in the sea of uncertainty, is being too rigid on that plan and not being flexible. So everything you do should be flexible and should be able to be adjusted if life changes. This one's important for the next webinar. Understand Social Security and Medicare. It is complicated, and I'll tell you, everything to do with your income when you're going to claim Medicare, Social Security, what age to claim, it is literally a detailed flow chart of decision points. It is not as simple as people think it is. And decisions you make can have a lifetime of impact, especially if you're going to live for a little while. So take the time to understand Social Security and Medicare and work with somebody who understands it to help guide you through the process. Simple example is, what's a common thing? People say, oh, I'm going to sell the house and I'm going to downsize. And they do that the year they retire. And they also go on to Medicare that year because they retire at 65. Great. You just sold your house. You just had a huge capital gain. Your income looks really big. You look wealthy on paper. Have fun with those Medicare costs. Okay? Medicare premium costs. Different drug plans, things like that. It's a complicated world, and it's going to impact everybody of a certain age. So please get guidance on that. And again, that guidance should not be just Social Security and Medicare. Your total plan matters. Every dollar that you can optimize is another dollar in your pocket. Okay, final one on this is, think of planning, not just financial. This is a big one. So why people think, again, it's not fun is this finance. It's boring. I got to look at my portfolios. I got to look at my numbers. I got to look at my spending. I have to figure out how much I spend on stuff. It's not fun for the vast majority of people unless you're in finance and you think that stuff's cool. Tie it with your life's purpose. Tie it with how you see your life in leisure, like your enjoyment. Tie it with what brings you joy. You don't have to have a life purpose. Just what makes you feel happy now? What makes your heart sing now? What makes you feel good now? How do you incorporate that? We are not here to generate giant pools or giant piles of money to stare at. That is not our purpose of existence. The money is the platform. The financial planning and the money and the portfolios and everything you have is the platform for you to live your highest, most rich, meaningful, and purposeful life. The money is just that. It is not a tool of evil. It is not something to be coveted. It is a middle ground to provide that. But pulling it all together with the purpose is what the driver will be for doing good quality financial planning. So I hope I did a good job in covering these things and talking about this. I know that some of this will be edited and kind of organized into better videos. What has been my motivator for doing this is continuously hearing the following words when people come talk to me. I wish I had talked to you 5 years earlier, 10 years earlier, 20 years earlier, when people realized that they could have done a lot better job at being prepared for that work optional stage of their life. And that is the thing that really keeps me awake at night more than anything else is I didn't know you 5, 10, 15 years ago. I don't advertise. I only find people when they get referred to me or maybe they watch these videos. I wish I did too, because I could have done more than I can do today. So just having that opportunity to get the word out to people about the importance of this, but also tying it to your life and to your purpose and to your meaning is really the high motivator for this beyond the finance. Know that myself and Katie and our team at Sequoia are doing this for you. We watch this constantly, and if you knew how much we talked about you, your ears would probably be burning. But we are also always available anytime you have questions. And for any of you watching this for the first time or have questions, feel free to reach out. Happy to answer your questions. Whether or not you decide to work with Sequoia, at least it will help get you on your path to creating your optimal financial plan. So thank you very much, everyone, for listening. I cannot express in words the tremendous amount of gratitude I have for your confidence in the work that we do. This is as much from the heart as it is from the mind. And my highest intention is to take this off your plate so you can enjoy your life and live your purpose and do the things you enjoy. Do know that I am available. If you have questions, shoot me a message, reach out, we'll get on the calendar and we'll talk. I try to find that careful balance between pestering you or bringing this to your attention all the time, all the things I'm doing, and also making sure I'm available when you have questions. So don't hesitate, reach out when you have questions. Coming into year-end planning. So if you do have things coming up year-end that you think it's important for us to know, we may not know, or something else has come up you want to make sure we're aware of, We'll be reaching out to people individually we feel is something important to know as we get to year end. But please also, don't wait for us. Reach out to us and we'll get you on the calendar sooner if you have questions. Thank you so much, everyone, for listening. Again, greatly appreciate having this time with you. And I look forward to seeing you at next month's to be able to get the expertise. Oh, okay, sorry, that was just a response. You are most welcome to the messages. And I look forward to seeing you all at the Medicare Social Security one next month. Please keep a lookout for this. We'll try to get the dates out early and send the link to your friends that may be impacted, your community groups. This is a big deal. It's really something that impacts just about everybody. So thank you, and I'll see you in a month, if not sooner. Bye for now.